Good evening, everybody. And thank you for coming along to this hybrid event at LSE. I welcome especially new students. I'm sure there are many of you who've not yet been to an LSE event. This is the latest in a series in which we've very distinguished speakers from broadly speaking, the central banking fraternity. I mentioned, for example, Vítor Constâncio, who was the former governor of the Portuguese central bank. And we have also here Niels Thuessen, who was chairing the European Fiscal Board. Still are or not? Still, yes. And Piercaro Padoan, who was Italian finance minister. So you're in very distinguished company, and I'm sure I'm leaving out other distinguished individuals. My name is Ian Begg. I'm a professor at the European Institute, and I'm delighted to be joined this evening by Ignazio Visco, former governor until very recently of the Italian central bank, the Banca d'Italia, by Jörg Kukies, who recently was the German finance minister, having served also in the chancellery and a more junior role in the finance ministry. And apart from that, having a long period with something called Goldman Sachs. They're a bank or something, aren't they?
Heard that, yes.
And we also have, I'm pleased to say, Vicky Pryce, someone I've been cooperating with for what now, 50 years, Vicky?
If you have to say that, yes.
In various ways. Vicky is currently at the Center for Economic and Business Research, formerly Chief Economic Advisor to the British government, and many other distinguished roles. So I won't dwell on the individuals in much more detail, but I'll give you a bit more when I introduce them to speak. Phones off. Yes? We don't want phones interrupting the meeting. If you are an ex-user, apparently we have something called hashtag LSEEI, which you can quote if you were disposed to start pontificating on X. It's the LSE tradition, for those of you who are new to the public events, that we allow plenty of time for discussion. When it comes to discussion, the questions and answers, it will be around half an hour. I propose to take questions in groups of 3. They need to be short, they need to be focused, and they should tell us who you are. There's also an online audience, and they will be potentially submitting questions via whatever system you have here. Zoom, is it all right? And Laura over there will let me know. With that said, let me turn first to our main speaker, Ignazio Visco, who, as I mentioned, is now Governor Emeritus of the Banca d'Italia. I think that's a normal honor for somebody who spent 12 years in the post of governor, having risen through the ranks to be running the economics department and running as the deputy governor. He's a very distinguished economist. In spite of his 12 years as the head, he's looking very, very well, I have to say. Survived. As a member of one of the important countries in the EU, he was automatically a member of the Governing Council of the European Central Bank, where you survived at least 3 presidents, I think. Two presidents, all right. I thought you might have seen the tail end of Pryce. And I do know, because I've been spying on his background, that he won prizes as a student at both La Sapienza in Rome and at Penn in the US. So he's a very distinguished economist. I won't dwell on it much more, Ignazio, so I give you the floor. Prego.
Thank you. Thank you very much. Good morning, good evening, good afternoon. Thank you for the invitation. It's nice to be here. I love having young people to talk with, being accustomed mostly to people of my age, so that is a good news. I'm going to talk about this fragmentation in Europe, and especially focusing on the single currency. But the framework is really has to start with somehow recalling that there is a major rise in global uncertainty, and it has to do with the second term of Mr. Trump. Some commentators, academic researchers, public officers have thought that this is an occasion in which perhaps the role of the dollar will be weakened, and Europe may get its act together with institutional reforms, somehow more attention to a stronger geopolitical position, and the euro might benefit. Now, we should question what does benefit mean, but becoming perhaps a stronger currency in terms of it being a fully fledged reserve currency, besides maintaining a role of payments in particular regions. Now, I have doubts, as many others, on this thesis, even if it is a thesis that you may find in a very recent paper which was presented at the Brookings panel and is going to be published this fall in the Brookings Papers of Economic Activity, which claims that the euro, given the level of tariffs that are going to be put in place by the US administration, will see somehow a role changing and become perhaps take the role of the euro that the dollar had. Now, we know that the strong currencies need strong economies, not vice versa. Strong economies with civil society, with institutions, with security systems that really behind them. And Europe is far away from that. Europe doesn't even have a market for a safe asset, a common safe asset. And in such divided Europe, despite the ambitions raised and expressed in the most recent reports by Enrico Letta and Mario Draghi, a higher degree of integration is unlikely to materialize within this decade. In fact, the big problem is that we had a system, international monetary system in place with the British pound, strong power in the British Empire. We had a system, international monetary system centered around the dollar after Bretton Woods agreements. When the Bretton Woods agreements somehow ended in 1971, we had still a dollar-centric international monetary non-system. And we have lived with this non-system for decades. Now, thinking that we can move to another non-system with a different currency, I think is something preposterous. It will not be the euro, it will not be the yuan or the renminbi. The obvious issue is that we are missing a major component that has characterized the last 20, 30 years, which is international cooperation. Without international cooperation, it's very unlikely that we're going to have a system of any sort. So most likely, we'll have a lot of volatility and regionalization, perhaps, but we don't know. I mean, this is something to be discussed. Obviously, the uncertainty is certainly going to cast to the United States' role as a safe asset in the world, because that was based not only on security, on the economy, but also on the rules of law, on the certainty of rule of law. And we are seeing that there is a weakening there. And this comes hand in hand with a dramatic landscape at the world level. Dramatic on conflicts, which are really something that we thought would not have been coming back, but we have ongoing wars, we have aggressions, and we have nationalist and populist upheavals, which is not only limited to some countries in the old continent. And we have a decline of multilateralism, a weakening of international cooperation, extreme weakness, I would say, and we have rising protectionism. However, let's see if I can play with this. More or less, this is that line. I'm going to talk first about this rising world uncertainty and Trump. But, this is how uncertainty is skyrocketed. Actually, I mean, this is the number of indicators. They all tell the same story. The interesting thing is that, however, it already started to go up in the first term of Trump. Now it went to the skies. The Protectionism, however, started before Trump. It is before this new US administration. It's a longer story. It may start when somehow the G7 started questioning, and rightly so, the way China maintained its role as a still developing economy. And when Obama met Xi and complained about aggressive policies in terms of also industrial espionage, if you want, a number of things. But it started already with sanctions, with tariffs increased, maintained by the Biden administration, as a matter of fact, increased, reciprocated by China, and then it continued, and it's not here because it ends in 2023. What we have is that given this starting protectionism, actually we also had, however, some reasons for that. Among the reasons, there are imbalances. And there are domestic imbalances and external imbalances. Domestic imbalances are very easy to see. We can just look at gross general government debt, and you see that it is going up straight in the United States. It stops in 2024, but the projections are for it going up for the next couple of decades. It's increasing in China and in other emerging countries, and it is continuing to increase. It stopped at around 90% after the global financial crisis in the euro areas, large European Union in general, and it's matched by an increase in private debt at the global level. We have some outstanding, incredible figures by now, about $250 trillion in total debt at the world level. We came from something like 150 only before the globalization move. So this financing of debt of states, nations, and enterprises is one issue which is behind the scene. The other issues, however, is external imbalances. And we have been talking about the current account. This is where tariffs are mostly coming into the scene. It was amazingly already diverging in the years before the global financial crisis, 2007, 2008. It has been reduced in terms of ratio to GDP, the deficit and the surpluses, but we still have maintained a deficit, ongoing deficit in the United States on the current account, and a surplus in China, major partner of the United States on trade, and in the European Union after the global financial crisis. At the end, these are major imbalances that once you accumulate, give you a story like this one, the international investment position, which has a counterpart, the accumulated indebtedness that comes from the current account deficit. And to that added the value changes on the assets and liabilities of the US residents has increased from 20% deficit negative position at the beginning of this century, more or less, already still just after the global financial crisis, to 90% today in terms of GDP. It's an amazingly large number. However, it is not due, this increase, to the current account. The current account has been staying to 50% for the last 15 years of total GDP, the accumulated thing. It is a large figure. It is a trend which is behind it, which is, I think, unsustainable. But what has really materialized is the following: it is an increase in values. What we have today is what has been said by one of the most attentive commentators and scholars, researchers who work on this. Many small creditors and one only one large debtor in the United States. Debtor is a difficult concept in this data, because obviously behind this there are two things. There is the current account, one thing, and the assets which have been increasing in value, but in the prices. But the issue here is that it is half debt and half equity. And what really is behind this is the increase in equity values in the stock prices of the companies which have non-residents as owners in part. 30% of the corporate America is in foreigners' hands. And this is mostly technological. This is the NASDAQ. If you look at Magnificent Seven, as they're called, everybody knows who they are, Apple and Amazon and so on, you get something amazing. Between 2015 and today, the value of this company has increased. The return has been 2,415%, which is almost 40% per year if you compound it. It's incredible. The question is it going to be maintained? What is behind that? Obviously, a lot of investment, good investment, innovation, good innovations, financed by a lot of capital also from outside the United States. Europe is certainly one. The Commonwealth countries are a major counterpart. And it has also monopoly power. And it has monopoly rent, market power and monopoly rents. And there are people like Acemoglu who questions whether they will be able to maintain their innovation once they start moving from profits to rent. Now, the interesting thing here is that also the exchange rates have played a role. 5/6 of the increase in the net international investment position of the United States, negative, are due to the values of corporate America. 1/6 is due to the depreciation of the dollar. It works through the value of non-US assets owned by US residents. If the dollar appreciates, the value goes down. The interesting thing here is that also the return of the equities in other markets than the American ones have done very dismal. In dollar terms, we have 370% increase of the whole corporate value in the US, 25% of the rest of the world. So this is an amazing problem. Before going there, the issue here is, I think, on one side, the good performance of the American economy, on the other, what is claimed to be the dismal performance of the rest of the world. Mario Draghi wrote this report, and he says that there is a big gap in competitiveness, really he wanted to say productivity, and in investment. Now, productivity, probably there is not much. If you take per capita output, you don't see much, but prospective, yes, because investment in Europe is, in percentage terms, is with GDP equal to US. But if you look at that, it is mostly construction, extremely low return. And what is missing in Europe is intangibles, exactly that thing that is behind the current account deficit in services that we observe in Europe. What we have is this story. Tariffs are needed, according to Trump, to cut the current account deficit. Actually, he wants to use them taxing indirectly American consumers to finance the government, who can then deliver with these revenues fiscal cuts in reduction in taxes and so on. But the idea, tariffs are in principle linked to the deficit in the current account as large. But the US has a surplus in services, and it has an amazing surplus with respect to Europe, which is not at all discussed in in the actual negotiations. And actually, if you look at the statistics from Eurostat and BA, you see that in the BA it doesn't come very much. Why? Because it goes through multinationals, American multinationals located in Ireland. These multinationals, according to Europe, they are obviously European. And in fact, we import through them the services, and 90% of the services deficit is due to this thing. In the case of the exports, also 30% of exports of services goes through these multinationals. Now, this is interesting because these intangibles, which basically are licenses, copyright on software and other things, these are basically charges on the use of intellectual property. These are extremely important. Also, if you think to what Mario was really pointing out, there is a technological gap. And the gap, you can see, it has to do to the gap between Europe and the United States. He compares mostly the United States. In fact, some critics say that he ignores both the rest of the world, China, which is, I mean, there is a lip service there, but it is not much identified as a model, and obviously it is not a model, but the US is a model. Now, these days, we think that it's better to have other models, perhaps. But one issue which has to be underlined is that in Europe, there is, in continental Europe, certainly, there is a lot of value priced on the welfare state, on social justice, and so on. And if growth is going to be dismal, well, the sustainability of this will be hard to maintain. So this is a very relevant issue. And this calls for discussing the two things, the demographics and technology. The demographics, Europe is actually aging much more than the US, and its population is somehow 450 million. It will remain that for the next 20 years. The rest of the world as such will increase 2 billion, which means that this will be all in other than advanced economies and China. And at the same time, the population of Europe will move from 9% to 4% in the 60 years from 1990 to 250. That 2050. So now 2050. Now this demographics has with it a consequence. There will be a substantial reduction in working age population. You can match that with increasing participation in the labor force, raising retirement age, changing immigration laws in order to try to have a managed immigration that could help. But all these need two things. One, education, the human capital that we can import is, and the human capital actually in place in Europe is not adequate with the technological changes. And second, you need productivity. But how to raise productivity if you don't have investment in those factors of production which are the ones which matter today? And this is what both Letta and Draghi work on. You need a single market which is larger, speedier, more effective, harmonized, which means harmonizing legislation in sectors like company laws, in sectors like finance and securities, taxation, and so on. It's a wide range of proposals. There is one proposal that is in latest report, which is to have a 28th principle, which is you have 27 countries, 27 legislation. Let's have another one, and voluntarily people in different countries may choose the European one. I have a little bit of doubts on this. It did not work for company law. It may be considered for moving exactly in that direction, which is missing in Europe, which is financing innovation. How do you finance innovation? You have startups. startups need finance from the market. And in Europe, if you are so fragmented, they will be too small and will not grow. And as fragmented means different regulations, different laws. And what you have is, this is the way household assets are allocated. In Europe, mostly to real estate. And if not real estate, to liquid assets. If they're liquid, means deposits, but also guaranteed instruments in the capital markets. Capital markets in the United States are 56%. There are many reasons behind that. We can discuss about also the way inheritance laws imply that wealth is maintained across generations and so on. But this is a picture which is really important. Coupled with this one, the assets managed by the private sector in Europe are extremely low. The total is, I would say, one-fourth, one-third of the US. The US economy is 40% larger than the European one, but the difference is too wide. Especially, there is no venture capital. As a matter of fact, if you look and try to understand a little better, venture capital in Europe is not only 1/6 of what it is in the United States, but comes from outside Europe and goes to established companies. It doesn't go to startup companies. So this has to be reversed. In a sense, latest suggestions, and I read all the work which von der Leyen and all the staff there have produced in the last year. I think much of that makes sense and is good. The problem is implementation. And the political divisions in Europe are, for the time being, something that does not seem really to be conducive to somehow positive results. What about the euro versus the dollar? Well, the euro, obviously, I said, does not have a background of a strong economy, good institutions, and so on, and there is fragmentation. Still, it is, as Tommaso Poloscopo will say, a currency without a state. But it is not necessary to have a state for the currency to survive. It is necessary to have a state for the currency to remain strong and play the role that some is seeing. But you need a safe asset and global, and you need the common policies. And these are hard to get. On the payment side, well, perhaps the dollar may maintain its value. We have, I'm not going to talk about this, but we have all these Genius Acts, stable coins, and so on, dollar-backed tokens, not really issued by the federal government, but they may have implications that we may discuss perhaps later for Europe, which are being discussed now also by the ECB. One issue is we should work also to have a digital capital union. To close, I think this is my thing. Safe assets. There is a proposal recently by Blanchard and Ubide to move part of the government debts, individual countries in Europe, to a single fund. And with that, say 60%, you build a 5 trillion euros market, which is important and good. I am not against that. As a matter of fact, the Bank of Italy had an identical proposal in 2019. The Bank of Italy delegate here was one of the authors of that. But and I've been, as a governor, explaining that this could go with legal requirements being satisfied without changing the treaty and with more hazards being contained. I think this could be something that should be discussed also with the German intentions now to have their debt requirements to be bypassed, or with the French mess that we are living. But this is something that we may discuss later on. Only thing to conclude is I think that there is one thing that we should consider Today, in 1932, Mr. Bidwell, important political figure, said there is a way out of the way of concerted action, international economic cooperation, perhaps a dream. We know how it ended. Christine more recently said, today to make history, we must learn from history. I think this is a good time to learn. Thank you.
Grazie mille, Ignazio.
Prego.
Let me ask you just one short question. Are you on the optimistic side or the pessimistic side?
Depends whether I have a glass of water and I can look at it. Well, this looks a bit pessimistic.
Okay, thank you. We'll now turn to our two discussants. I've already, broadly speaking, introduced them, but one or two additional elements. Jörg, you reminded me that you were a student in France. Quite unusual for a German economist, I think. And this was at Paris 1 Panthéon, which is a very nice university. It must be because they once invited me to be a visiting professor for a month. So with no further ado, let me ask you for your comments or any additional factors you want to bring into this discussion. Thank you. No,
Yes,
it's already.
it's working already. Yeah, thank you. I'll just focus on a few topics and then we can enter into the debate. First of all, I think the question of competitiveness is really front and center because the European Union once was at par in terms of overall economic power measured in GDP terms with the United States not that long ago. Now the United States is 40% ahead of the European Union. So I think this is one of the key questions that if one region of the world grows with 2.5% per year, the other grows by 1% or even less per year over a few decades, that really turns into a huge asymmetry of economic power. And of course, at the moment, Europe is suffering from that. So in that sense, the optimistic version of the story is that, as the governor has said, there is a game plan. Europe has a game plan presented by Mario Draghi almost a year ago, which received huge amounts of applause from the industry, from policymakers, from academics, from researchers. So in a way, the roadmap is set. And all we have to do is use the proposals in the report by Enrico Letta and by Mario Draghi, both of which were applauded heavily, combine that with a bit of the report from Christian Noyer on the Capital Markets Union, which was also applauded quite heavily. And all of a sudden you have a plan how Europe can emerge from its very slow and lethargic growth. The big problem is 1 year after the publication of all of these reports, which were applauded hugely, we've not seen any legislative proposal that really implements these things. There's a bit of work now on securitization. There's preliminary work on the individual industrial reforms that need to be done to make us more competitive in the chemicals industry, in the pharmaceuticals industry, in AI, in digital, in automotive, but the actual legislative work hasn't even started yet. And if I see how long it usually takes Europe to go from proposal to enactment of legislation, we are still years away from actually implementing a roadmap that a year ago everyone applauded. So I think this is the key question of how willing and able is the European Union not only to sort of self-criticize itself and analyze its deficiencies, but actually do something about it and to implement policies that increase competitiveness instead of always burdening the economy with more and more regulations. And I think that's one of the key deficiencies in the thinking of the European Union. I'm just rereading the book, The Brussels Effect, which was written about 6 or 7 years ago. And that literally made the claim that the European Union has a big competitive advantage of regulating its industry heavily. And because of the importance of the internal market in Europe, essentially exporting its regulatory mindset to the rest of the world, because the rest of the world having to sell to the at the time 500 million consumers in Europe didn't have the choice but to respect European regulation. The problem is, strategically, if you become less and less important as an economic region, because instead of having 100% of US GDP, you all of a sudden only have 70 or 60, then the decision matrix of global companies with respect to adhering to or circumventing the Brussels effect, of course, changes. And in a way, you have negative convexity, meaning that the weaker you are, the more you burden your economy with more and more regulation, the less relevant you become because you're a less relevant, sizable market. And if everyone else decides to circumvent you instead of adhering to your policies, the effect actually worsens every time you can choose to put a heavier regulatory burden on your industries. And I think this is something that the European Commission has understood, hence the applause for the Draghi report and enhancing competitiveness, deepening the internal market. The IMF estimates that the implicit tariffs within the European market are as high as 40%. But it now needs to be enacted. There's some positive news. For example, one of the policy measures that I think the European Union is embarking on, given the trade conflicts with the United States, is to basically say, okay, if the United States wants to increase the hurdle for international trade, then we will strike free trade agreements with regions of the world that want to reduce tariffs and barriers. Hence, it's very positive that the European Union now wants to finalize the free trade agreement with Mercosur in Latin America, with Indonesia, with the Gulf Cooperation Council, et cetera, but also that needs to be enacted, that needs to be passed, and we have to overcome all of the resistance against this, because only if we compensate the lower volume of expected trade with the United States as a result of tariffs with our so far biggest trading partner, with diversifying into regions that want to engage in free trade, only then will we be able to compensate this. The second big point that I would like to make is on capital markets. I think there is a correlation that is underestimated in the European Union between our lack of financing of intangible assets and our pension system. The US-UK pension system is very prone to encouraging equity investment, both from a regulatory perspective, from a tax perspective, and from the whole construction of the pension system. The pension system in these regions of the world is much more flexible and much more capable of financing business models that lend themselves to equity financing. For example, intangible assets that can't be pledged and that promise a return further out in the future, potentially supported by negative cash flows in the near future. If you look at the evolution of Amazon, Facebook, Meta, Google, NVIDIA, you name it, all of them had very long periods of negative cash flows before they started to crack the code. And if you imagine the founders of those companies going to a European commercial bank asking for a loan on their intangible assets, namely the ideas in their brain and the software on their computers, it would have been a very short discussion. However, the US system has been capable of funding these business models with equity, most of which comes from the US pension system and the North American pension system. So I think it's no surprise that both the comparison Europe and the US shows that the country with the stronger capital markets based equity finance system generates much more economic power with business models that require equity financing and are less prone to debt financing. And within Europe, those countries, let's take the example of Sweden as a positive example, that have been brave enough to equitize their pension systems, have also seen the benefit of that through a much more active capital markets for companies that, again, are more in this intangible capital world than the traditional industries in the rest of Europe. So I think this is something that we have to take into account in addition to all of the points that you made, also in the whole question of pension reform. The last point that I want to make is demographics, because I do think this is a question where the glass can be very full in Europe, because the regions of the world, like China or Russia, who are suffering from adverse demographics, will struggle to attract global talent to their countries as long as they stay in the governance state that they are, versus Europe, which has a huge opportunity to attract global talent to Europe, especially if the entry barriers to probably the United States, in addition to the equity capital markets, strongest growth enhancer, namely being the magnet for talent from around the world, is reversed, and prices are being charged, visas are being revoked, and the whole concept of being able to study, set up companies, join companies is at least made more uncertain. Germany passed a law that all of you from outside of the European Union can very easily obtain work permits in Germany, and we've seen a real inflow of talent from outside the EU, because we basically studied Australia, Canada, and the US when the US was still talented migration friendly, and reduced the barriers for visa applications, work permits, et cetera, et cetera. The first indications are that there's great interest, but I think this is a question that Europe really has to unify, because if we want to have a uniform mobile labor market, then of course Europe has to have a consistent and coherent migration policy, not only for humanitarian migration, but also for skilled migration. And that is something where I do believe other regions of the world are at the moment taking decisions that will in the long run harm their economies, but Europe doesn't yet have a concept of, like openly inviting talents from around the world to come to Europe and to take up work here. Because in Germany, at least, when we polled the companies, what are the constraints to growth, lack of skilled labor was always among the top names. So I think this is one area where through quite easy reforms, Europe could enhance growth quite substantially.
I detect just a note of optimism there. Vicky, as I said, I've known a long time. I don't know if you remember, Vicky, the very first time I met you, I listened to your accent and thought you were South African. And you had to correct me and say, no, I'm Greek. Barakalo.
Yeah, which indeed I am. And of course, I've written a book called Greekonomics, which took us through the story of how terrible it all was during the Eurozone crisis, and how, of course, I argued that Greece was very badly treated by the Germans. But that's besides the point. But there is a real issue. A number of the things that have been mentioned, I just touch on, because I know we want to get to the questions. I mean, on demographics is an interesting one. Again, I mean, Greece is seeing its population dropping very, very significantly if nothing is done. And of course, it has had huge migration coming in from former Eastern Europe after 1989. For some reason, lots of Albanians decided they were part of this as well, so they all came, and now they populate Greece, which actually is brilliant, because otherwise we'd be in trouble. The question is, how do you attract also more capital? And Greece is moving in that direction. But I think all the points that were made about how the EU can rethink the way in which it's constituted, structured, and so on, are really important. And the Draghi report is absolutely spot on. But there are some issues. We talked about the ECB, Europe. I mean, you could argue that one of the reasons why I'm here is also because I am a woman. I mean, so we have to balance it out. And looking at the governing council of the ECB, apart from Lagarde, of course, who's in the executive, is of course the head, and Isabel Schnabel. Everyone else is a man. I can't think of a central bank governor who is a woman. I don't think so. Of course, I would say that all the decisions are made are not particularly good either. as a result, but you need to have that type of balance. But the reason why I'm saying it is that because at the time of the Eurozone crisis, you could argue that we had the euro a little bit too early. It was very unfortunate when you talked about the differences in the economic growth between the US and Europe. If the euro had come a little bit later and didn't coincide more or less with the financial crisis, you would have had a very different growth path, because Europe indeed was doing, rather well. And then with the euro and all the limitations that were there in terms of not being able to do anything about your currency, not being able to expand your debt if you wanted to, it limited hugely what Europe could do. And of course, Draghi again had to intervene and reduce interest rates quite significantly. And it is interesting that, in my view, what we have seen is this, a very positive point, is this real understanding that the way things weren't going to work for Europe. So the whole institutional framework was changed. What I was doing, looking at my phone, is how the ECB describes now its job, which of course includes hugely lending to the central banks and providing enough liquidity for all the banks that need it, and basically being what it wasn't during the Eurozone crisis, a lender of last resort. And also, of course, moving into ensuring that not only is liquidity available, but the quantitative easing, which Draghi called for, is the one that really helped Europe during the period when it was first talked about, even though it took 3 years because of the German reluctance to allow this to happen before it was introduced. But nevertheless, everything to save the euro, if you all remember, was what Draghi said, and the markets believed it and behaved accordingly. But a lot was lost in the meantime as we were moving to that. And of course, one of the things that we talked about today is how do you get to move even further? I think the ECB, interestingly enough, when prices started going up after the end of COVID and supply chain issues were there and everything else, was actually the last to change its interest rates until, if I remember, July 2022. Interest rates, the deposit rate that the ECB was offering was still negative. And of course, they moved it since, but they were one of the first to start bringing it down. Really quite aware of, despite the differences in the various countries, that actually they needed to support the economy a lot more than if they had just followed the US and UK example. So I actually, despite the lack of women in this governing council, think that there's been such a dramatic change in terms of the way the ECB is thinking and is proactively helping the economy. Also, the deposit rate still is quite low in terms of what the banks get when they have reserves with the system as well. The UK is not doing that. It's actually paying an awful lot for the banks to just leave the money with them rather than lending it. So, and it does pursue very, very closely the way in which, and follows the way in which the lending market and the sort of financing conditions are moving in Europe. So it is unfortunate that we lost so many years of low growth. But what is fortunate is that there has really been this complete shift in terms of an active and really actually quite benevolent in many ways central bank that is also there to support individual countries if they have a problem in terms of the capital markets with a new sort of transition or transmission mechanism, whatever it's called, which this facility that's been set up, which means basically that there is money available, even though QE has finished, quantitative easing, to help particular countries if they have a problem with borrowing in the capital markets. But here we are. Yes, we talked about France, raised that issue, and Germany, of course, still being able to borrow a lot more cheaply. But nevertheless, I mean, Greece, if I can turn back to that, the rates at which it borrows right now are below those of France and below those, of course, of the UK, which is considerably higher, below those of the US. So, and the ability, I think, to get to grips with what's happening particularly on the worries about deflation that may happen in Europe is actually quite positive. So if that is the case, if indeed a whole institution with the backing of the Germans, the French, and everyone else, has moved in that direction, helping the EU, and has actually backtracked a bit on regulation as well, just going through your points, because it knows that it has to be competitive. It deals with Trump and the tariffs that you spoke about. Maybe it's given in too much, and Lagarde is being, sorry, von der Leyen is being attacked for that. But I think that we've moved, from my standpoint and looking at Europe, from a position where we didn't want to do anything together in terms of mutualization of debt and so on, into one where some of the suggestions that have just been made about putting all the debt together and rethinking, particularly with all the other forces around us, Russia and everything else, and the US threat and China threat, I think we are in a much better position to get some of the Draghi competitiveness recommendations through, particularly on the capital markets, which I think will make a huge, huge difference in the future if the path that I've seen happening so far intensifies. Obviously, there are political issues, countries that differ. We know all these and resistance, but indeed the examples that you already, Sweden and others that you've mentioned, show that this can happen. That the investment in firms can indeed occur from within the EU, particularly if there is a pensions industry which is united, and the capital market can actually act the way it should, because actually at the end of the day, it should be bigger than the US. Okay.
Thank you, Vicky. I've picked up just a few words which I'm going to throw out to inspire questions, but I'll ask one or two quick questions to the panel first. So here's my list of words: uncertainty, divided Europe, dollar decline, Europe's challenges and possible responses, better financing mechanisms in Europe, in particular pensions, and maybe a fresh approach by institutions like the European Central Bank, which might include hiring or employing more women. So these are the things that you may pick up in questions. Now, while you reflect on these, let me ask a first simple question. It says in all the slides that this is the European Institute at LSE. We have a focus in our institute on political economy. So my question to all three of you, please very short answers so we allow plenty of time for the audience, is, are our politicians and institutions equipped to deal with the challenges you've all expressed? Jörg, why don't you start?
Well, I mean, no doubt, yes. It's not a question of capability of policymakers. I think it's a political question. Are we willing to take measures that are controversial, that will incite some protest, and that also include some acknowledgement that the swing of the pendulum of regulating everything at a very micro level in Europe was the right path to take in the first place. So I think it's not a question of quality of policymakers or if policymakers are equipped. The fact that, European policymakers mandated 2 Italians and 1 Frenchman to show us the way and to pave the road for a roadmap shows that there is awareness of the problems. Now, the big question is one, will we be brave enough to implement this? Because as we've already seen, there's plenty of protest against it. There's plenty of skepticism and statements like we should just carry on in our old ways. There's plenty of views that say, oh, we just need European debt and that'll solve the problem. But I'm firmly of the view that we need to be brave enough not only to expand our fiscal stance, which Germany has done, but also to tackle the structural problems in our economies that will then allow us to raise all of this debt at interest rates that are reasonable and that will allow us the breathing room to fund economic growth.
Ignazio?
Well, I'm not talking about individual politicians. I mean, I suppose
No, I mean the system as a whole.
it is the system. Now, the problem is that Europe is divided. We had a good experience after COVID of unity and ability to behave. We had a terrible time at the sovereign debt crisis. I think there was a mistrust wrongly somehow emphasized by the markets, but that was a bad experience. We are having not a good experience now also in the dealing with Trump and Putin and so on. Europe is, I mean, in one of the main points of Draghi's report is institutional reform. You need the majority votes, you need a number of changes that are not taking place now. There are national interests, perhaps myopically, but they are really at the core of the political decisions of individual countries. So you really need a strong reform. Then once you have done that, they will be equipped, but it is besides the point. The problem is it is fragmented. And it's not only fragmented in markets, or in economics and so on, but it's fragmented politically. And this is a major problem. There is no trust which is permanently there as it was in the 70s, 60s and so on, when things were done often together in the vision of the common market and then the European community and then the European EMU and so on. So this is the problem. The other point is that I think at the very end, politicians have to be short-sighted because if they want to be re-elected, they have to promise things that are realized during their term. And we are talking about things that have to realize much after. And this is the major challenge for politicians in Europe, but for politicians at the world level. I mean, the US is a clear experience. So, I mean, we hope for the best and we have to try to advise politicians. You went in the game of politicians. I always refuse to go in there because I'm not equipped to that. I mean, I'm sure that you always tell the truth, but most politicians, if they want to survive, they have not to tell the truth.
Vicky, in particular, do you think the European Central Bank is now a more normal central bank?
Yes, I think it is. I mean, the interesting thing is that, of course, it is worrying about issues that were mentioned in the lecture, which have to do with can the euro be a proper reserve of international currency? And why do they want that? Because they think that the power of Europe will increase and also the stability in Europe will increase. And I think the ECB is quite keen on that. There's a talk going on just today on this by one of the executive council members, which she was giving in Italian, who has been arguing about how a digital Europe is absolutely essential because we need this for resilience in Europe. Otherwise, we're too dependent on the US financial system and it can just all go out in flames, particularly because we use all the credit cards and the contactless things which are run by US firms. And of course, we're still dependent quite a lot. There is an issue on the type of liquidity arrangements that the US can give us. So being more, in a way, separate from this and self-reliant seems to be what ECB thinks.
Not to mention secondary sanctions as a major threat. Anyway, time for questions. As I said, we want to do them in groups of 3. And there is an LSE expectation that a sufficient number of the questions will come from women or people identifying as women. So is there any woman who wants to be first?
I don't raise my hand.
You never know.
Yes, you here. Wait, please wait. If you can use the microphone there or wait for one of the roving ones. Does that one work? Speak. Okay, well, let's use the roving microphone.
Hi, Danny Starlova, BNP Paribas, and also LSE student now. I have a question about this new German fiscal package that's kind of been touted as a seismic shift in fiscal policy in Europe that's going to be a rising tide that lifts all boats in the Eurozone. Common pushback that I get from speaking to clients and things is that there's no reason to think that this time is different, that the government will be able to deliver given how much bureaucracy there is. And we saw this issue with the NGU in terms of actually getting the investment out into the economy. And there's also a lot of questions around the efficacy in terms of the fiscal multipliers and how efficient the spending will be. So my question is to the panel, just generally, what are your takes on this? Is this time different, or will it be the same story in Europe that we've seen before?
I'm going to take two more questions, maybe one here, please.
Thank you, John Eugene, member of OMFIF. I apologize for not being a woman. I identify as human. An observation and a
My
question.
formula.
An observation and a question. The observation is the euro is a uniquely frustrating currency. It's frustrated all those who hoped it would fail, and it's frustrated all those who hoped it would become a world currency. And the question I have for the panel is, what will it take for the euro to become a world currency? Will it take a federal debt market? Will it in fact take a federal treasury?
That's very succinct. Third question, right, so up here. I can see a hand at the back, but I can't see the person. We'll come to you in the second
You can
round.
try and use your microphone if it's working. It's on the right button in front of you.
Okay, does this work?
It's not on.
You have to just press. Oh, here. Yeah. Now try.
Okay, hi. My name is Sören Verheim. I'm an alumni of LSE. My question is kind of in line with the first question, specifically that a lot of Eurozone countries are also members of NATO. And obviously the NATO countries have pledged quite extraordinary amounts of money for defense spending, which they intend to entirely finance through new debt. My question is that is this massive amount of additional debt for defense spending, the trillions of euros across the Eurozone, is this going to have an impact on the stability of the Eurozone and the single currency, given that some European countries already have a high borrowing cost as is?
Okay, thank you very much. As you can see, quite disparate questions. Ignazio, why don't you start, please?
Well, I'm not going to talk about Germany, of course, but my impression is
You
is
may.
that- No, there are a number of chapters in which we have really to do more and better. One of them is energy, the other is defense. There is nothing you really can do to avoid going in that direction. Are they going to be growth enhancing? I don't think so. I mean, defense is not, well, there might be some areas in the intangibles applied to defense that in the future may generate growth, but in the time being, probably there is not going to be a significant effect, nor from energy move from fossils to renewables. They are needed, however. And there are chapters. There is a lot of talk about this 800 billion that Mario had in his report. I think too much. I think we have to talk about items where we can really see effects. I think Europe has to be less dependent from the rest of the world, both in defense, but also in satellites, cloud, a number of, and so these are the areas which have to be identified and on which European politicians have to work. Then I think at the end, resources have to be found, can be found. I'm not pessimistic on that side. I think there must be a good combination, private and public, and the private has to be enhanced, private investment, and I don't know pension funds, but certainly there are a component, there are a number of other components, but we have to think of the market as a single market. We cannot still have heterogeneous legislations that somehow are applied to different chapters. And defense being all members of NATO, individual members, the Union is not a member of the NATO. There is a lot to be done on that side. There has been a discussion. You have seen that at the end, they agreed to maintain their own military, but there is much more than military. There is a lot of defense spending which goes beyond people and hard are the means. So that is an area which there is a lot of work to do. The Germans have made the decisions alone, not joint decisions. The French are the ones who have always had a separate view on defense. As a matter of fact, 1954 was a major failure. We didn't have a political unity because of the decisions of French not to have a defense unit. So, and they have obviously a nuclear chapter, which the others don't, and this makes a difference.
Vicky, I don't know if you want to try answering the question on Germany in case it is awkward for Jörg.
No.
Well, I mean, all I would say is that there has been, I mean, whether it happens or not, I will leave it to the gentleman here to answer. But there seems to be some intention, but there's still political issues there in terms of getting it underway, as far as I understand it, and it might take some time. But there was a study, I listened to somebody talk about defense spending more generally, and we're looking at the UK, but also more generally, and the increase that is happening. Or, of course, remember, it's already happened quite significantly. When you look at the percentage that is devoted to defense has been creeping up just recently, in any case, across most countries. And that excludes Russia, of course, where it's been very big. And it said that actually defense spending does support growth in the economy, but only if you borrow for it. So if you increase taxes and therefore you sort of do it that way and then move it on to defense, it doesn't. Now, you can say that to the defense companies, of course, whose shares have all gone up very significantly. So they obviously think there's going to be some good stuff there. And there are all these people who argue that defense helps if you spend there because it's got all sorts of trickle down event. You work with IT firms, AI, et cetera, and that can then be quite helpful, as you've seen happen in the US, in terms of technology companies and technology taking hold in lots of other sectors. So there is a real advantage in doing it, possibly, but that's a very long run thing. And you have to have a lot of faith that the transmission mechanism works properly in your country.
Jörg, you can pick up whatever you like.
Yeah, no, I would, I have no problems answering question on Germany because the question was very specific. And I would say the key insight is that in the German government, there is a clear understanding that fiscal expansion and structural economic reform are two sides of the same coin, and one will not work without the other. First of all, because the investors in Bunds will drive up the yield for Germany to incur debt if and only if the structural growth problem isn't solved. There's many examples of how expansions of debt, if it's not accompanied by growth, can lead to quite difficult situations on the funding markets just to raise the debt. It's the R-G question, if you will. And therefore, the consensus in Berlin is definitely that we need economic reform, first of all, to keep down the funding costs, because we have to prove structural growth and growth potential can pick up and production capacity can pick up. But on the other side, also, there is an awareness that to deploy the funds, planning and permissioning have to accelerate. We have an instrument. We were able to set up import facilities for natural gas in world record time. And this system of accelerating planning and permissioning and reducing the ability of NIMBY crowds to file lawsuits and delay infrastructure projects has now been rolled out from gas infrastructure to 5G networks. There's draft legislation going through that. It'll also be rolled out to road construction, railroad construction, and other infrastructure. That's not passed into law yet, but it's, like at the level of agreement within the government that if we want to succeed in this, we need also hard tools to accelerate. I'll give you an example that it's not only about import terminals for gas where you can get quick results in Germany. The construction of the largest munition factory in Germany was decided on a greenfield In March 2024, the first munition shells were produced on the fully finished and constructed factory in August, just 1.5 months ago. So that shows you that there's not only sort of talking, but actually doing that is allowing companies to get quicker. Another example, case in point, the CEO of one of Germany's largest defense companies in an interview on this weekend said that the order flow he's getting from the German Defense Ministry has increased by a power of 10 relative to pre-constitutional change levels. I was in Munich visiting defense tech startup companies just 2 weeks ago, and they all told me that the procurement policy of the German Defense Ministry has changed fundamentally, whereas it used to be that they required, track records of years and years of profitable business has been changed, and they actually place orders with young technology-driven defense tech companies. So, there's a lot of indication that this is not only talking. The German defense minister has just announced a 35 billion program of defense tech in space, because we're seeing more and more threats coming from the fact that we are underinvested in satellite technology, etc. So all of these examples will try to convince you that things have changed, but of course this now also needs to be implemented. I think that's exactly also going in the direction of your question. But the question of what does it need for stability of the currency as a result of all of this expansion of debt-financed defense procurement is, of course, R minus G again, right? I mean, if Europe doesn't prove to financial markets that we can use the potential of this fiscal spending on defense financed in large part by debt to structurally grow our economies, then financial markets will charge the European governments very high interest rates and therefore threaten the stability. If on the other side, Europe shows by implementing the Draghi report, et cetera, that we are willing to embark on a different growth path, and we are a more safe region to invest because we can look out for ourselves and not rely on volatile decision-making processes in other parts of the world where we have been free riding, which is probably a causal reason why the decisions in the US are so volatile, because we are seen as free riders in Europe, and to a large part that is legitimately so, then a virtuous cycle can develop. And again, also on the question of what does it take for the euro to become a global currency, I think that's also related to that. If financial markets in the world trust and believe and see evidence that Europe is not growing 1.5% slower than the United States of America in the foreseeable future, then the view on the sustainability of the European debt markets will increase, then the willingness to put reserve currency in the euro will increase, and therefore you will have a virtuous cycle of more and more trust being put into Europe. So I think this question of reversing the growth weakness of Europe is one of the key strategic issues that Europe has to tackle.
I think Ignazio has a two-hander. Just a
No,
20-second.
I agree with this, with the exception, obviously, that you need financial infrastructures like more or less what we have in the current reserve currency, and we don't, because we don't have a common infrastructure in Europe on that. We don't have a common safe asset. We need a market which is sizable and liquid, and we don't have that. So we have to work on that.
Okay, we're going to do another round of questions, starting right at the back, and I'm also going to go to. Do you have a microphone in front of you?
Well, I hope to.
Do, but you haven't tried it.
Thank you very much. I'm Benedetta Morari. I'm a PhD student at the European Institute. I work on EU foreign policy and I teach EU politics courses here at the LSE and Wake Forest University. And I guess my question is more about governance rather than the economics of it. But we've seen a lot of the underlying discourse under the EMU, the creation of the single currency, and even still under in the Draghi and Letta report is really like this idea of integration, full-on complete integration in all economic sphere to be the ultimate goal, or at least an ideal status for the EU to reach. And that is also seen as kind of like the solution to a lot of the current problems that we're seeing. But then if we look at the current state, we talked about unity and
Could you
disunity.
try to get to the question
Yes.
quickly, please?
It's disunity seems more of a fact and a condition, like a permanent condition rather than a momentary one. So I guess my question is, what do you think the future European economic architecture will look like? Are we going to see full-on integration, or what will it look like in a patchwork of cooperation formulas?
We also have some questions online, but I'll give you the floor first.
Does this work? Yeah. So actually, my question ties a bit into her one.
Tell us your name and
Yeah,
affiliation.
sorry. Yeah, I'm a MSc student at European Institute. My name is Boudewijn Welksijn. And I actually had a question about this 28th legislation you were talking about. You were kind of pessimistic about it. And for me, I don't understand why, because I've seen that differentiated integration has worked. It's working now in defense. It's working now with energy as well. And I was wondering, in this world we live in with European fragmentation and how everyone's taking their own course, why can't we do differentiated integration with this capital markets union?
Okay, Laura, online.
I have a question by Joaquin Schwering. In 2015 and 2016, the EU adopted a capital markets union and a startup and scale-up initiative. Next to nothing happened. In 2025, it adopted a savings and investment union and a startup and scale-up strategy with nearly the same content and ongoing disregard for digital finance. Do you expect anything to be different now regarding their chances of success?
Okay, I'm going to break with the principle of 3 questions because we're running out of time, and ask one more at the back here.
Your respected delegation, honorary speakers, I'm Jörg from Nepal and studying global political economy of Europe and China and the world. And my question is like 2-part, but my first question is, what are your—
As long as it's quick.
European regulation on financing non-tangible assets, distributed ledger technology, tokenization and cryptocurrency. And the other part is declining dollar dominance and with the fragmented Eurozone. What's your take on BRICS currency, on single currency in an uncertain world? Thank you.
I don't know if you heard that. Can there be a BRICS currency as a competitor for the dollar or the euro?
The BRICS.
BRICS. It was floated by one of the BRICS meetings. So
I don't know. I mean, there is a lot of work on digital currencies, and you know, Brazil, for example, had a lot of proposals. They have put them aside for the time being. I doubt that this is really, there is, you need institutions for that. And obviously these do not come out of countries, nations, or systems which really are in the making rather than established. So I don't think that this is, I think that as far as the international monetary system is concerned, the only solution would be cooperative one. You may start perhaps having dialogues. There is a lot of discussion about the union of the willing, those who would like to do things together. But I think we have, I mean, there was an attempt at a certain point to do things in a more cooperative way, and it failed. The basic issue is that you need to have a common currency at the global level. And this cannot be a unilateral currency. So and it is a non-system that is prone to fail. That is so I think that I'm very pessimistic on this. I think we are going to have a lot of fluctuations and volatility until there might be a major crisis, and after a crisis, you then get your act together.
Let me get a quick take from you, Ignazio, on Capital Markets Union or the Savings and Investment Union? Why is it stalled? Why doesn't it make
Totally
progress?
right. I mean, it was a failure from the beginning. It went on. We have been talking about the major problem, I think, is harmonization. If you don't harmonize legislation, it is really very difficult to have a union of markets. You need to have rules on insolvency, rules on the business companies, which obviously they tried to have, but the 20th regime did not work. You need to have rules on securitization, securities, or intellectual property. And all these at the end, because intellectual property has something to do also with the software that is going to be used in the common market and so on. So it has been a failure. Now there is a lot of work, a lot of understanding that you need it to work in order to finance the projects that are necessary for a number of reasons, be that to reduce dependency from the US, which has to be done, be that for defense, be that for energy. So you need really to have a market that works efficiently as a market rather than a summation of small markets. This is, I'm on this, I'm a little bit more optimistic, to be fair.
Jörg, is it a governance problem?
Well, I mean, first, the question, is full harmonization needed? I think the answer is it depends. The big question for where there is harmonization needed is to ask businesses, small and large, what is preventing you from scaling your business models across borders in Europe? What is causing this dispersion and consumer protection laws, meaning that a fintech startup that is set up in Estonia not being able to roll out its services to 27 member states in the European Union, just as a fintech startup founded in Arizona can easily roll out its product to 50 states in the United. I think that's, like in a very succinct way, the key test on whether harmonization is needed or not. You don't need harmonization of everything. And by the way, American states have different standards occasionally as well. But the big key question and determinant to me for harmonization is the question, does it impede the rollout of pan-European business models? 28th regime, I would actually add a flavor of optimism. Look at the rollout of the Société Européenne, which was essentially, I mean, if you will, is a way of a 28th regime. The problem, I think, is it is reserved for very large companies. But for very large companies, the ones who adopt it are actually quite happy with it. And it is a common European framework outside of the national corporate governance. And you're right, it's too little. But I think the key question is, can Europe be brave enough to set up something like the Société Européenne from the cradle of a startup all the way to a mature company that reaches the SE level, right? I mean, that would be revolutionary if, whether you're in Estonia or Greece, you can online set up a company under a European legal system that is the same in all European companies. And if you're a carpenter and you only want to provide services locally to your domestic economy and you have no interest in expanding in Europe, you can stay with your domestic system. But if you are a startup that wants to conquer Europe and then the world and have a lower cost of expansion, then from day one, you can already set up all of your infrastructure digitally in a pan-European framework. That is an idea, but it's an idea that will be discussed in the Savings and Investment Union, Capital Markets Union. On that one,
I have to move on to Vicky because we're almost
okay,
done.
I haven't answered all questions, but
I'm leaving some for Vicky.
exactly.
You can ask me a question, or am I supposed to? Oh, right.
The governance question.
The governance question. Well, I mean, it's interesting because John's earlier point about whether we need a federal treasury and therefore much more integration across. I think there is a point in that. And it is true that you talked about different regulations and other things of the sort that are stopping some of that integration from happening. You know, the pensions industry, the way you can carry your pension across. And yet, what we see, we consider that to be a real stopper, And if you look at the UK, okay, so there are all the other systems that are quite different, yet our pensions industry only spends something like 10% of its investments in the UK. The rest goes somewhere else. So they're able to do it. So it's not necessarily stopping one from having the type of sort of big capital market that you want. If there are opportunities out there, but there is no doubt that there are differences still which prevent some of that happening. And it's interesting. I think I read, and I may have dreamt it, but I have said it a couple of times because I'm sure I read it, that some of the Eastern European countries and some of the Baltic states have actually got together to have a joint stock exchange or a joint pension system, which they're going to be developing, which I think is a way forward in terms of, not everyone harmonizing, but having decisions on who is closest to someone else and doing it that way. And I don't think there's anything really wrong with that. Of course, it disadvantages others who haven't really quite gone into this, and which is a problem with Europe, because maybe then you make countries. It was always the concern that you might get some of the big countries getting closer together and the rest are just left, and they will be suffering as a result. But I think it can be done, and it certainly should be done in the meantime until we wait for something bigger to in fact finally happen in Europe, which I think is going to be so important and positive if it were to indeed materialize this savings and capital union that we're talking about, and investment unions.
Well, very briefly on differentiated integration, it's already in place. The only question is which model: variable geometry a la carte, which is the British preference, or multi-speed, which is many other countries' preference. There's a whole menu of different things that could be done. But sadly, we're out of time. I know this is going to be very frustrating for many of you who had brilliant questions to ask. This is the fate when you have such excellent speakers that they want to give you their opinions. So I hope you will join me in thanking our three speakers for their excellent contributions, and I hope you enjoyed the event.